how you can make money in your sleep using dividend paying stocks. That's what we're talking about today. I'm glad you're here. If you're new here, I'm Austin. I'm a co-owner of cloudmusicsuite.com, and on this channel we talk all things money and personal development. So if that sounds up your alley, go ahead and subscribe. And as a thank you for subscribing, here is a picture of my beautiful kitty cat. She's so sweet. All right, let's get into this thing. We're talking about dividend stocks, and dividend stocks are a way that I can make more money without putting in more time, okay? Everyone wants probably two things, I'd say. Everyone wants more time to do what they want to do, and everyone wants more money to do what they want to do. But a lot of times we have to end up trading our time for money. And that is an unfortunate situation because in order to get more money, we have to spend more time oftentimes, right? But if I have more time, then I'm not working as much, right? So now I have less money. We need to figure out ways so that we can make money without it being tied to how much time we put into something. And one of those ways, lowest barrier to entry way probably, is with dividend paying stocks. So let's talk about what a dividend is first of all. So a dividend is a cash payment that a company is going to pay you for having an ownership position with that company. So when you go to the stock market and you buy a stock, you are now a part owner of that company. As it's teeny tiny, right? It's teeny tiny, but you are a part owner of that big pie. Even if it's just a little sliver, that's okay, because you can get paid real money, okay, to hold these shares. They're going to say thank you to you as a shareholder for holding shares of that company, and they're going to say thank you by sending you a cash payment in the form of a dividend. And that dividend normally comes every 3 months. Sometimes it's monthly, sometimes it's every 6 months, and sometimes it's once a year. But almost always it's once every 3 months for a nice dividend stock. They take a portion of those profits that they're making because they're a profit generating company, which is a great position to be in, and they pay out some of that to you in the form of a dividend. So that's kind of what a dividend is. And I want to talk about how to treat dividend money real quick. So dividend money is going to come into your account, even if it's just 5 cents or a few dollars at a time to start with. It's still money that's coming into your account. It feels so good. It's so powerful. It starts to change your mindset around money. It's like, wow, I can put money in here, spend no time at all after my initial research work on this company, and I get paid. You know, I'm getting paid to hold these ownership shares. It's a really cool thing, and it's very motivating to make you, push further and make more dividend money and make more dividend money. But with this dividend money, it comes straight into your account, and best option would be to keep this money invested in your account, at least while you're on your wealth building journey. Maybe 30, 40 years from now, we can start taking that dividend money out, or 20 years, or whatever your time horizon is looking like. We can start taking that dividend money out and using it to fund our lifestyle. But when we're first getting started, there's really no need to do that. So just let the dividends roll into your account, and you can have a DRIP program. That's called Dividend Reinvestment Program. And that's offered by some brokerages where they can automatically repurchase shares of the company that just paid you a dividend. If that's your preferred method, that's very hands-off. That's cool, go for that. If not, you can just have them flow the money into your account, and then you take that money and buy more stocks with it. Maybe you buy other dividend stocks, maybe you buy the same dividend stock, maybe you buy some growth stocks. Now, let's talk about a few strategies real quick. Those two strategies, I would call them dividend money now and dividend money later. The dividend money now, you would want to go with a really high yielding stock, maybe like 5, 6, 7%, something like that. Some of those examples could be something like AllianceBernstein. They pay a very high dividend right now. Another example could be Intel Corporation. They pay a very high dividend right now. And then another one could be AT&T stock. They pay a high dividend right now. Those three probably have a lot less growth in terms of that dividend over time than some other stocks that pay a much lower dividend. So that would be my dividend money now. If you're a dividend money now investor and you really want the money now, you're not worried about the dividend growth over time and that dividend going from $5 a share to $5.25 a share to $5.50 a share. You're okay with it just staying how it is. That's fine. That's a totally real strategy, and you can do what you want to do. What I think is a better strategy is dividend money later. So the dividend money later strategy, I want a lower payout ratio so that the company has growth that they could just increase that dividend over time. If nothing changes at all, company becomes no more profitable, they can still increase the dividend slowly over time. That would be good. Much better situation is the company has growing revenue, the company has growing earnings, and they have a growing dividend, even if the dividend is lower right now. So 2 examples of a low dividend right now with a great growth rate and a potential for that dividend to totally skyrocket over the next few years. Costco is yielding about 0.7%. And then Apple has a very low yield as well. So Costco and Apple, number 1, they have a lot of cash on hand. We can check the balance sheet quick for that information. Number 2, they have really low payout ratios. When we have low payout ratios, that means we have a lot of potential for dividend increases over time. And then number 3, their revenues, meaning the total money that's coming into the company, is growing at a substantial rate, and the earnings for these companies are growing at a substantial rate. So that would be the dividend money later strategy, because if I have a compound annual growth rate of that dividend around 13%, like Costco has, and I just wait 6 years, okay? Compound annual growth rate 13%, I wait 6 years, I've more than doubled my initial investment. So if they keep that, let's say the dividend starts at $1 today, you buy the stock today, 6 years from now, if they keep this 13% compound annual growth rate, it'll be a $2 dividend. No matter, the company could become no more profitable, the stock price could go nowhere, and you would be getting paid double as much 6 years from now as you were today. So that's a thing of beauty. That's what we want, in my opinion, because I want money later, right? My time horizon is pretty long out still. I'm still pretty young. So I want money later. I'm not worried about getting huge dividend checks right now. What I want is the dividend checks to increase. Basically, I'm getting little raises, okay? I'm just getting a raise every quarter that they decide to increase their dividend. I just got a raise. Next quarter they decide to increase their dividend. I just got a raise. And then someone like Costco, who often pays out special dividends, they pay out these massive dividends every now and then, like $7 a share, $10 a share. It's crazy. So someone who has a history of those special dividends, that's really awesome. And someone who has a history of growing that dividend over time with a high compound annual growth rate, that's what we want. Okay, let me talk real quick at on the tail end of this video about what kind of screeners I like to look for in a ideal dividend stock. Number 1, I want it to be a stable business model. I don't want revenue and profit to be hugely crazy high one quarter and then in the gutter the next quarter, and then high the next quarter, and then in the gutter the next quarter. It's going to be harder for a company to sustain, maintain, and increase a dividend over time if they have a very, very, very cyclical business model like that. So I want stable cash flows. No matter how crazy the economic times are, I want stable cash flows over time. So that's number 1. Something like a waste hauler, like Waste Management or Republic Services. I want growing revenues. So I want the company to get bigger, basically, right, over the years. So I want maybe 10% revenue growth a year, could come down to 5% revenue growth, or even 3 to 4% revenue growth. As long as we're growing revenues over time, I'm happy, okay? I don't want shrinking revenues over time. It's gonna be hard to increase the dividend if the company is basically on the decline. I want the company to still be on the climb. Haven't hit their peak yet, right? I also want growing earnings over time. So I want the company to become more and more profitable as they scale their business up. So if today they're making $15 of EPS per year, earnings per share, I want them in the next few years to go to 16, 17, 18, 19, 20 plus, right? In terms of EPS, because earnings per share, that's how I get paid out as a dividend investor, right? If I'm a strict dividend investor, which I'm not, but I do own dividend stocks. If I was a strict dividend investor, the only way I make money, okay, is by that company paying me out some of its earnings. Of course, the share price can go up over time as well. That would be ideal. But just talking about dividends, they pay me out from the earnings. So I need the earnings to be going up over time. So that's number 1, stable business model, growing revenues, growing earnings. All right. Number 2 thing I need to look for, they must be free cash flow positive. We can look at this on the statement of cash flows. You can go to like Yahoo Finance or any stock screener at all to find this. Just go to the balance sheet, the financials area, and then go to statement of cash flows. All right. So we need them to be free cash flow positive. This is number 3. on a 1, 3, 5, and 10-year basis, I want this company to be growing dividends over time. Even if it's 1, 2, 3, 4, or 5% dividend growth, that's respectable. If we're like somewhere around 10% to 13%, that's amazing. That's amazing dividend growth over those 1, 3, 5, and 10-year spans. So I definitely want the dividend to be growing over time. Small growth, cool. Huge growth, awesome. Love that. All right. Next thing, I need a reasonable payout ratio. And in my opinion, a reasonable payout ratio is anything below 60%. Below 60%, acceptable. Below 50%, pretty good. Below 40%, great. Below 30%, killing it, okay? And remember, a payout ratio is total earnings on the denominator, right, in the bottom, and then amount of money that's being paid out on the top. So if the company makes $100 million in profit and they're paying out 50 million of that to the shareholders, that's a 50% payout ratio. And you can look at that on a per share basis if you want by doing some division, all right? Last thing I want to look for is ideally earnings per share are growing faster than the dividend is growing, because that means that company is not just taking all the new profit and paying it out to me. That company is taking some of the new profit and reinvesting it back into the business so they can grow the business, so they can grow revenues and they can grow earnings over time, right? So I don't want them to pay all of their free cash flow out to me as the investor. I want them to still be able to grow their company so that I can have the share price appreciate over time, as well as the dividend to increase over time. So those are my screeners that I use for dividend stocks. Let me know if you own any dividend stocks. I would love to hear about it. And hope you have a great day.